Centene reports first quarterly loss in 13 years. Stock experiences volatility. Updated. Unexpected loss disturbs the market. On July 25, 2025, Centene Corporation announced its first adjusted quarterly loss in more than a decade, posting a second quarter 2025 adjusted loss of 16 cents per share, as opposed to analysts' predictions of an 11 cents profit. Total revenue increased approximately 22% year-over-year to $48.7 billion, surpassing consensus expectations of around $44 billion. Nevertheless, this strong revenue growth could not counterbalance the sharply rising expenses. Reasons behind the loss: rising expenses and ACA/Medicaid challenges. The health benefits ratio, HBR, rose to 93%, up from 87.6% year-over-year and exceeding forecasts around 91%, indicating escalating medical expenses in Medicaid and ACA plans. A projected $1.8 billion shortfall in ACA marketplace risk adjustment revenue, equivalent to about $2.75 per share, was disclosed after analyzing data from 22 of its state exchanges. Pressure on Medicaid costs, including behavioral health care, home health services, and high-cost medications, intensified, further compromising profit margins. First loss in over a decade. While news reports referred to this as Centene's first adjusted loss in over 5 years, it is technically the first quarterly loss in nearly 13 years, reversing a $1.15 billion profit in Q2 2024 and marking a rare financial setback. Market response: volatile trading and significant sell-offs. In pre-market trading, Centene shares fell between 9 to 14%, depending on the source, before experiencing some modest recovery post-open in certain cases. Intraday volatility featured a sharp bounce of approximately 2.2% after the opening bell, potentially due to investor sentiment suggesting the worst may be over or opportunistic buying on dips. The stock dropped to its lowest point since 2014, down about 55% year-to-date, establishing it as the poorest performing stock in the S&P 500 for 2025. Strategic initiatives and analyst revisions. Centene pulled its 2025 earnings guidance earlier in July, citing uncertainty concerning ACA enrollment patterns and government subsidies. In response, the company is set to refile 2026 marketplace premium rates across key states to accommodate a higher risk pool and recuperate losses starting next year. Major firms such as Morgan Stanley, Jefferies, Wolfe Research, and others have downgraded their price targets and earnings predictions, some significantly cutting targets from around $70 to the low $30s per share, due to concerns regarding sustainability in both the Medicaid and ACA sectors.